DeFi is a term that you may not be familiar with. Would you consider DeFi applications to be a game changer in the crypto industry? Or is this simply more than hype? There's no need to worry if you've never heard of DeFi before, or if this video is your first introduction to the concept. Welcome to Altcoin Bull, the most popular crypto educational channel on YouTube. It is the goal of DeFi movement to create a new financial system that is accessible to anyone and doesn't rely on third parties for confidence. So DeFi depends significantly on encryption and smart contracts to achieve that goal. DeFi relies heavily on smart contracts as its primary building piece. You should be aware that the majority of DeFi initiatives at the moment are based on Ethereum. Ethereum's programming language, Solidity, provides a powerful framework for creating complex smart contracts that may be used in DeFi applications. In addition, Ethereum has the most established smart contracts ecosystem, with hundreds of developers creating new apps every day, and the greatest value locked in smart contracts that provide an extra network impact. Ethereum serves as the foundation for all of the DeFi protocols discussed in this video. Let's take a look back at where it all began. MakerDAO was one of the first decentralized financial projects to emerge. Founded in 2015, MakerDAO is a decentralized autonomous organization that allows users to lock up collateral such as Ethereum and create DAI, stable currency that mimics the price of the US dollar through incentives. DAI can also be utilized to save money on Oasis platform of the manufacturer. This is a recreation of a financial system pillar. In reality, DeFi is attempting to establish a new financial ecosystem in a permissionless and open manner through lending and borrowing. Only a small portion of the whole financial system involves lending and borrowing. In addition, stablecoins, decentralized exchanges, denominated derivatives, margin trading, and insurance are all important. Let's take a closer look at each of these groups. DeFi projects in this category include MakerDAO, as well as a few others. Compound is important. As of the time of this video's production, Compound was the largest DeFi lending operation, with assets valued at over $630 million. It is possible to earn interest on a variety of cryptocurrencies, including Ether, BAT, 0x, and Tether, using Compound's algorithmic interest rate protocol. Assets in the supply chain might be used as security for other assets. If we employ smart contracts and incentives, we can develop a stablecoin that is tied to real money without needing to hold dollars. AV is another prominent DeFi project. MakerDAO, which lets consumers lock in their collateral and create DAI, was previously discussed. This cryptocurrency, DAI, is a good illustration of algorithmic stability. Stable currencies like USDT, USDC, and Paxos exist in addition to DAI, which is an algorithmic coin. A major drawback of stablecoins is that they are centralized, as a firm is responsible for holding the stablecoin's value in the US dollar and other assets. Despite this, stable currencies like Compound and AV have grown in popularity and are often utilized in DeFi apps. If you're looking for a means to trade cryptocurrency without giving up your coins, you may use decentralized exchanges instead of traditional centralized exchanges. In terms of DEXs, these are primarily two varieties to consider: order book-based as well as the liquidity pool-based. Uniswap, Kyber, Balancer, and Bancor are some examples of the liquidity pool-based ones. Examples of order book-based systems are Loopring and IDEX. Derivatives are contracts, like in conventional finance, whose value is derived from the performance of an underlying asset. Synthetics, a decentralized platform that allows on-chain exposure to a variety of assets. It's the primary DeFi application in this area. Similar to conventional finance, Margin trading involves borrowing money to grow a holding in an asset. DYDX and Fulcrum are two of the most popular DeFi applications for margin trading. In the decentralized financial system, insurance is another typical financial service that may be replicated. In exchange for a premium payment, it offers certain assurances of recompense. Smart contract failures and deposit protection are two of the most common uses of insurance in the DeFi market. DeFi projects Nexus Mutual and Open are the most popular here. Oracle services, which focus on sending trustworthy data feeds from outside world into smart contracts, are another crucial aspect of the DeFi ecosystem. Chainlink is by far the most well-known endeavor in this area. The DeFi ecosystem may be summarized in this way. Additionally, there are countless ways to mix them. We may think of them as money Legos because more complex DeFi products can be created on top of the blocks already in existence. Here, we'll examine the key distinctions between DeFi or decentralized finance and CeFi or centralized finance. Don't forget to hit the like button if you made it this far, and thank you for watching. There is no KYC in DeFi. CeFi approval KYC sanctions are a type of identification verification. Free and open source cooperation is encouraged by DeFi. Decisions are taken behind closed doors in the CeFi private closed source environment. Censorship proof. DeFi. CeFi is subject to censorship. DeFi is less expensive in terms of network expenses. Expensive CeFi intermediates charge a large price of their services. On the blockchain, DeFi was created. CeFi was constructed on a basis that was already there. Now, before we conclude this video, it's important to point out the dangers of DeFi use. Bugs in smart contracts and protocol changes that might disrupt current contracts are two of the biggest threats. Additional insurance can also be purchased to reduce the risk of future problems. That's not all. We need to know how decentralized a DeFi project is and what the process is for shutting it down should things go wrong. To shut down the protocol, does anybody have an admin key, or is there some unchained governance in place to make such a choice? Additional systematic risk can be produced by asset price declines that cause a cascade of liquidations across different DeFi protocols. This must be taken into consideration at all times. If you wish to prevent liquidations and, let's say, deliver additional collateral on time, network cost and congestion might be a concern. This issue may be alleviated by Ethereum 2.0 and the second layer scaling solution, both of which are currently in development. Particularly less visible features or modifications that relate to one of the protocols may encourage users to take certain behaviors that can cascade across several protocols. Something like this might be seen recently in the Compound protocol, where users were enticed into what appeared to be high-interest borrowing, which was advantageous since they receive more comp tokens as compensation. As terrible as these events may be, they help to strengthen the environment and make it less susceptible to future disasters. It is clear to everyone who has a look at DeFi that it is a dynamic and exciting place to be. But keep in mind that this is still a relatively young business. Therefore, there is a significant potential for loss as well as gain. In contrast to most of the similar digital startups, DeFi is built on new rails instead of depending on adequate technology and procedures, and is the closest thing to genuinely disrupt the existing financial industry. Currently, the vast majority of financial products can only be developed by banks themselves. Unlike the internet, DeFi is open, trustless, and facilitates collaborative work. We may see additional DeFi projects develop on non-Ethereum networks in the future, even if Ethereum is the primary blockchain on which it is now running. Once again, this is the Altcoin Bull channel, bringing you the best and most updated news and trends in the crypto world. If you like this video, don't forget to subscribe and hit the notification bell. Thank you and see you in the next one.